Hey there, I'm estate planning attorney Paul Rabalais, and in this video we're going to talk about how in America the gift tax reporting system is broken. So every year many people are required to file a gift tax return, but they don't. Maybe you gave your kids a chunk of money, maybe you gave them the down payment for their house, maybe you bought them a car, maybe you gave them a piece of land, maybe you paid their mortgage for several months. You may be violating gift tax reporting rules because our estate and gift tax laws mandate that when you make a taxable gift, you must file a gift tax return. A taxable gift is any time you make a gift that exceeds $15,000 to someone in any calendar year, whether you gave them cash, a piece of land, stocks, a portion of a business, you have to file a gift tax return. Their gift tax return is referred to as IRS Form 709. Some people comply with the gift tax return filing requirement and some people don't. The problem is if you don't comply, the penalty structure has no teeth because the penalty structure rarely applies. The gift tax return penalties seem to be modeled after the failing to file an income tax return penalty. When somebody doesn't file their income tax return, there's likely significant penalties that apply because the penalties are all based on a percentage of the amount of the tax that was due. Whereas with gift tax returns, when the failure to file a gift tax return penalty is based on the amount of gift tax due and no gift tax is due, then really there's no penalty for failing to file. Let me give an example. Dad, during the calendar year, makes a gift of $115,000 to his son. Is that more than $15,000? Certainly it is. It exceeds $15,000 by $100,000. He made a $115,000 gift. So Dad is required to file a gift tax return. Nobody owes any tax. What the gift tax return is, it's Dad reporting to the IRS that Dad has used up $100,000 of his $11.7 million estate and gift tax exemption. So by Dad reporting that he made a $100,000 taxable gift, nobody owes any tax. But now when Dad dies, he can only leave $11.6 million free of the federal estate tax instead of $11.7 million free of the 40% federal estate tax. So let me give you an example of how the gift tax reporting system is broken. Let me give you two different examples. Let's take Compliant Carol. During Compliant Carol's lifetime, she made taxable gifts of $5 million. These were gifts that were in excess of $15,000. When she did it, she always filed her gift tax return, IRS Form 709. She filed it timely with the IRS. And then years later, maybe decades later, when Compliant Carol died, Compliant Carol's executor on Compliant Carol's estate tax return certainly acknowledged that the $5 million of taxable gifts have been made. So now Compliant Carol can only shield $6.7 million of her estate from the 40% tax instead of $11.7 million because during Carol's lifetime she used $5 million of her $11.7 million exemption. That's the way the system is supposed to work. But let's take a look at non-compliant Nancy. Just like Carol, non-compliant Nancy made taxable gifts during her lifetime of $5 million. But non-compliant Nancy never filed a gift tax return. Now, years or decades later, when non-compliant Nancy dies, one of two things will happen. Either non-compliant Nancy's executor will acknowledge that many years ago, Nancy had made $5 million of taxable gifts, and when Nancy dies, Nancy's executor will go ahead and file those gift tax returns many years late. But there's no penalty for that because there was no tax due when Nancy made those gifts because Nancy was just using a portion of her $11.7 million exemption and no tax was due. And since all of those failure to file gift tax return penalties are based on the amount of gift tax due, there's no penalty for filing those returns 20 years later. Now, what also might happen when non-compliant Nancy dies after having made $5 million of taxable gifts years before and not filing any gift tax returns Either non-compliant Nancy's executor doesn't know about those gifts, or maybe non-compliant Nancy's executor engages in some selective amnesia and those gifts never get reported. So Nancy's estate now, on the estate tax return, it leaves structured so that another 11.7 million is exempt from the estate tax. So non-compliant Nancy really benefited from failing to file the gift tax return. Had she gotten busted, well, she could have always filed those returns much later with no penalty provision. So the penalty is hollow because there's typically no tax payment required with the filing of a gift tax return. So non-filing donors typically face no consequence from failing to report that gift on a timely filed gift tax return. So what should happen? Well, I don't know exactly what the solution is, but maybe for penalty purposes, you ignore the lifetime exemption. So penalties for failing to file a gift tax return should be based on the amount of gift tax that hypothetically would have been due had the taxpayer already used up their exemption. Now, so that's an example of the penalty provisions having some teeth. But there's lots of solutions, but I really feel like our current gift tax reporting system rewards the people who don't comply with it, which is not the kind of system we should have. Anyway, wanted to get that off my chest. I've been dealing with that for decades as people have consulted with me and asked me questions like, Paul, yeah, I mean, last year we gave our son a piece of land. It's worth $600,000. What if we don't file a gift tax return? And I have to tell them, there's going to be no penalty for not filing it because there's no tax due, and all the penalties for failing to file the gift tax return are based on the percentage of the tax that would have been due. So it's been a kind of difficult ride here, trying to encourage people to be compliant with all of our tax laws, but having a set of tax laws that really rewards people for being non-compliant, it's difficult. So anyway, give me a like and a subscribe. That'll help me out. We'll see you next time.